This video covers the statement of cash flows. The statement of cash flows shows users of the financial statement how the cash balance went from the beginning of year balance to the end of year balance. And first, we're going to go through the categories of cash flow. So you can break down the change in cash balance into 3 different types of activities: operating activities, investing activities, and financing activities. We'll go through those categories briefly. Then we'll go through the operating cash flow metric in particular. And the reason we'll go through that in detail is that we use an indirect method when we compute operating cash flow. So we'll go through 5 examples of how to calculate operating cash flow to get you more comfortable with how that's done. First, the categories of cash flows. We break these down into operating activities, investing activities, and financing activities. Operating cash flows have to do with the primary revenue-generating process in a business. So you calculate operating cash flows by taking cash you receive from your customers, that's in making sales, revenue transactions, and subtracting all the cash you paid for operating costs, such as buying inventory, paying for employees, and so on. Those are operating cash flows. Investing cash flows, these have to do with buying and selling investments or long-lived assets like PP&E, investments, and other long-lived assets. So we calculate investing cash flows by taking the proceeds that we get into the business from selling long-lived assets and subtracting all of the expenditures that we make paying cash to acquire long-lived assets. And that's how we calculate investing cash flows. Finally, financing cash flows, that's when we raise new funds from debt or equity investors. So the investors pay money into our company. That'd be a cash inflow. Or we have money in our company that we're comfortable distributing out to our investors. So we distribute funds out to our debt or equity investors. So those are financing cash flows. Now, if you look at a cash flow statement, it's going to be broken into these 3 categories. But there are different methods for computing these measures. For investing and financing cash flows, they are calculated using something called the direct method, which is you're going to see activities on the cash flow statement that relate exactly to these boxes. You will see lines on the cash flow statement that say that they are proceeds from selling long-lived assets, for example, or expenditures to acquire long-lived assets. In the financing section, you'll see captions on the cash flow statement saying something about raising funds from debt or equity investors or distributing funds to debt or equity investors. So it's a very obvious presentation on the cash flow statement. Operating cash flows is slightly different because we use the indirect method to compute operating cash flows, which is to say you will not see a caption on a cash flow statement that says cash received from customers. That would be a direct method, operating cash flow. We use an indirect method, which we'll go through in detail now. The indirect method for computing cash from operations is basically an algorithm. It's a formula. It starts with net income. Then we make adjustments to net income to arrive at cash from operations. What are these adjustments meant to do? Well, they're meant to take things out of net income. What kind of things do we want to take out of net income? We want to take anything out of net income that is not operating. So, because we're trying to calculate cash from operations, if there's any operating gains or losses in net income, we want to take those out. What else do we want to take out of net income? Well, we want to take out anything that's not cash. And so we remove all of the non-cash transactions from net income. And after we make those adjustments, which is explicitly laid out in this list here, we'll arrive at cash from operations. And now we'll go through 5 examples where you see specifically how net income is converted to cash from operations. And we'll go through these 5 different examples with one transaction at a time. Let's first consider this transaction, depreciation expense of $500. First, consider the journal entry for this transaction. It's a debit to depreciation expense on the income statement and a credit to accumulated depreciation. Well, let's first, before we get to the statement of cash flows, let's talk about the income statement impact of this journal entry alone. There's no revenue account in this journal entry, and so there's no impact on revenue. But Depreciation expense is an expense. It appears on the income statement. So our expenses are going to be $500 on this income statement, which, remember, only reflects this one transaction. Therefore, net income is revenue of 0 minus expenses of 500. Net income is minus 500. Okay, now the important part. Let's talk about the statement of cash flows. Remember, we're going to convert this net income of minus 500 to operating cash flow. So we'll start with net income, which was minus 500. And if you'll remember, the first item on the formula was to add back any depreciation or amortization expenses. So we'll take net income of minus 500 and we'll add back depreciation expense. So a minus 500 of net income plus depreciation expense of 500 is operating cash flow of 0. And that should make sense. If you look at this journal entry, it's not involving the cash account at all. So our operating cash flow should be unaffected by this single transaction. Okay, let's move on to number 2. Number 2 is selling consulting services on credit for $700. This is a revenue activity, so this is an operating activity, but we're selling it on credit. So we're not actually receiving cash yet. Let's first talk about the journal entry for this activity. It's a debit to accounts receivable of $700 and a credit to revenue on the income statement for $700. So we are recognizing this revenue even though we haven't yet received the cash. Let's take a look at how our income statement is going to be affected by this transaction. It's going to have revenue of $700. This transaction doesn't involve an expense in particular, so expenses are 0 here. And therefore, net income for this one transaction, $700. Now let's focus on the statement of cash flows. We start with net income of $700. And if you'll remember on the previous slide, one of the steps in the formula to convert net income to operating cash flow is to subtract changes in non-cash operating assets. Well, accounts receivable is a non-cash operating asset, and it went up by $700. It was debited by $700. So it went up. A plus $700 change in operating assets. But for the statement of cash flows, we want to subtract changes in operating assets. So we're going to subtract that plus 700. We're going to subtract 700. And we arrive at operating cash flow of 0. So you'll take net income, which reflected revenue. It reflected revenue of 700. But we need to adjust the net income because we haven't actually received the cash yet. So we subtract the change in the accounts receivable to arrive at 0 cash. We haven't received any cash for this transaction yet. So our operating cash flow is 0. Okay, that's example number 2. Example number 3. In this example, we'll receive a payment on prior services rendered. So you can think of this as receiving a payment on that previous accounts receivable, and we're receiving $100. First, again, we'll go through the journal entry. Receiving cash, so a debit to cash of 100. And we're receiving cash on accounts receivable, so we'll reduce our accounts receivable balance by 100. And we'll credit the accounts receivable balance to reduce it. Okay, now let's talk about the income statement here. As you'll notice, this journal entry just has 2 asset accounts being affected. So there are no income statement accounts being affected. There's no revenue in this journal entry, and there are no expenses in this journal entry. And so net income with respect to this single transaction is 0. But now let's talk about the statement of cash flows, because your intuition should be telling you that this is a cash inflow. And then you might ask yourself, is it an operating activity? And you should answer yes. When we receive cash from our customers, that's an operating activity. We should have a cash inflow of 100 on our statement of cash flows. So let's see how we get there. We start with net income of 0. But remember, that accounts receivable account, that's a non-cash operating asset, and it went down by $100. So the change in operating assets is a minus $100. And recall again, what is one of the steps in our formula to arrive at operating cash flow? We subtract changes in operating assets. So we will subtract that negative 100. So when we do that, we end up with a plus 100. So we start with net income of 0, and we add 100 because operating assets went down, and we end up with operating cash flow of positive 100. exactly what we were expecting to have. Okay, that's example number 3. Now let's talk about example number 4. Again, we're receiving a payment. We're receiving $200 in cash, and this is an advance for services to be provided next year. So this is a deferred revenue situation. The journal entry is a debit to cash for $200 and a credit to the deferred revenue liability account of $200. Now let's talk about the income statement. Notice that there are no income statement accounts here. So revenue, no, there's no effect on revenue. Expenses, there's no effect on expenses. And we have net income of 0 with respect to this one transaction. Okay, now let's do the statement of cash flow part. Again, we'll start with net income of 0. And now we have a slightly different rule. What we have is a change in an operating liability. Deferred revenue is an operating liability, and it went up by $200. So what do we do in our formula with operating liabilities? We subtracted changes in operating assets, and we add changes in operating liabilities. So we will add the change in that operating liability, adding 200, and arriving at operating cash flow of $200, which should be expected. Receiving a $200 advance payment from our customer, this is an operating activity and it's a cash inflow. So we had a $200 cash inflow from operating activities. Okay, that was example number 4. And now we'll move on to our final example. Example number 5. This time we're receiving $245 from the sale of PP&E. We originally purchased the PP&E for $300, and its accumulated depreciation at the time of the sale is $100. So if you take $300 minus $100, you end up with a $200 net book value. I call that the net book value of $200. And before we get into the journal entry and everything else, let's just think of the intuition here. We're selling something for $245. We're getting $245 in cash. Its book value was $200 on our books. So we're going to have a gain here on this sale. We're going to have a $45 gain. Now let's look at the journal entry to take a close look at it. Okay, let's go line by line. The first line is a debit to cash, the asset account, for $245. That's the cash we received for selling the PP&E. The next 2 lines are what we do to remove this PP&E from our books. We no longer own it. So that gross book value of $300, we need to credit the PP&E account to remove it from our books. The accumulated depreciation of $100, well, that's a credit balance, so we need to debit it to remove it from our books. And finally, to balance the journal entry, you'll see here we have our credit to the gain account for $45. I call it the gain account because this is not revenue. Revenue is when we sell inventory to customers or services to customers. This is neither one of those. This is selling one of our long-lived assets to customers. This is not the primary reason we're in business, so it's not considered revenue. That's why when you look at my income statement, I've had to add a line to it, because this is not revenue and this is not an expense. This is a gain account on the income statement. And so our net income takes this gain into account, and net income is a positive $45. Okay, now let's move on to our statement of cash flows, because this is going to be a little bit more complicated than before. And I'm not just going to calculate operating cash flow here. I'm going to calculate operating cash flow and investing cash flow, because this activity is an investing activity. So we need to show you how to calculate investing cash flow as well. Okay, on the operating section of the cash flow statement, we start with net income. We're using the indirect method. And if you'll recall back to the page where I laid out the formula for converting net income to operating cash flow, one of the items on that formula was to subtract out any non-operating gains. Well, that's what this is. This $45 is a non-operating gain. It's not an operating activity. So we need to subtract it out. We need to take it out of net income to convert net income of positive $45 to operating cash flow of 0. This activity, number 5, received $245 from the sale of PP&E. This is not an operating activity, and so it should not have an effect on operating cash flow, and it doesn't. So operating cash flow is 0. Now let's talk about investing cash flows. This is simply the proceeds from the sale of a long-lived asset. So the debit to cash of $245, those are the proceeds. So that debit to cash will show up exactly, because we're using the direct method, it's going to show up as a caption on the cash flow statement. It's called sale of PP&E, and it's positive $245. So when we compute investing cash flow, it's a $245 cash inflow. Okay, that was the final example number 5. So let's recap. In this video, we briefly went through the different types of activities represented on the cash flow statement: operating activities, investing activities, and financing activities. Then we spent a lot more time looking at the indirect method for computing operating cash flow. And the intuition there is that we started with net income, and then we adjust net income. We take out anything that is non-operating, so remember when we took out that gain, and we took out anything that's non-cash. So anytime cash wasn't actually changed hands, but net income was affected, we had to take that item out of net income. And so that's how we compute operating cash flow using the indirect method.